Let's take a look at what the macro and investment views mean for CIO view. We've just completed our latest investment team forum, involving all of our senior decision makers across the platform, drawing together the collective intelligence across macro, asset class teams, geographical specialists, and portfolio construction. We agreed on three main scenarios for the global economy. In our central scenario, we assume the oil price shock recedes, in line with futures pricing, limiting the economic damage. Broadening out resumes, albeit focused more on winners from the AI boom. Our upside scenario sees AI capex having stronger spillovers to the rest of the economy, pushing US GDP growth up to 3%. This would be a great environment for risk assets, although inflation risks would need to be monitored. Finally, there is a downside scenario, which is likely to involve supply-side risks, including the energy crisis, intensifying. The damage to risk assets could be significant, with many hedging strategies potentially failing. Three big themes inform our CIO view at this midpoint of the year. First, broadening out 2.0. Now, Joe mentioned earlier how the economic environment has changed. I certainly agree with that. There's a French saying, deux salles, deux ambiances, two rooms, two atmospheres, and I think that nicely sums up the disconnect between macro and markets we are seeing today. There's more inflation and hawkish central banks, growth downgrades for energy importers. Yet, the AI boom means the tech sector is driving stock markets higher. It's a tricky environment for market performance to broaden out, but we think a targeted broadening still makes sense, especially for those areas of the market that are adjacent to AI. Sectors like infrastructure, utilities, some industrials that are involved in the AI build-out. We like the profile of some of these more defensive growth areas too. Infrastructure, for example, continues to show low correlation versus the broad market. And in factor space, avoiding the crowding in the momentum factor with a multi-factor approach. Or an income strategy for equities. The performance of high-income equities has been impressive. In turbulent times, dividends are less volatile than profits. Second, I want to highlight emerging and frontier markets. Some analysts have argued that investing in EM now is just the same as investing in the US. Both have very large tech concentrations right now. But I think this misses several key points. Emerging markets are trading on much lower multiples than the US. Investors' positioning also remains light, we think. A weakening dollar is an important support for emerging markets and remains a key assumption in our central scenario. What's been really interesting in EM and frontier, as Joe mentioned, is also the resilience to geopolitical risk. We can see this in a few different ways. EM stock correlations versus developed markets or within emerging markets look surprisingly low. So there are country effects. Korea, for example, has been a huge outperformer, while India has lagged. In frontier markets, we see surprisingly low volatility too. And in EM debt, it's the same story, with volatility similar to Western bonds. So we think there is a lot to do in emerging markets right now, and some good return and diversification opportunities for investors. Third, I want to talk about income. Higher market yields in the US and Europe have created new opportunities for investors. Market expectations for policy rates look high, so duration can rally more if economic news deteriorates. Emerging market bonds, again, continue to be a bright spot, especially outside of Asia because of the energy shock. Nevertheless, some reduction in geopolitical stress could see markets like India rally. Credit spreads remain very tight. Equally, there's a very limited amount of stress right now. Defaults, rating migrations, all remain subdued. Profits are strong, and balance sheets are solid. An income-focused approach, exploiting high single-digit yields in investment grade and in high-yield areas, makes sense to us. But it's critical to screen effectively and remove the lower-quality names. The same selective approach makes sense in private credit markets. Again, we see high yield levels available. Double digit in private credit, high single digit in areas like trade finance and NAV finance. And we still see a lot of institutional investors attracted by that combination of good yields and low duration. The same selective approach makes sense in private credit markets. Again, we see high yield levels available, double digit in private credit, high single digit in areas like trade finance and NAV finance. And we still see a lot of institutional investors attracted by that combination of good yields and low duration. These are the CIO views for the second half of the year. Thank you very much for your continued support.